Hey everybody, I'm Zach.
And I'm Jesse.
You're watching Disruptive Investing, and this week I thought we'd bring you up to speed on a couple things going on. The first one is about Vinfast. So we've covered Vinfast before on Disruptive Investing. That's the Vietnamese electric car maker. They were founded in 2017. Last Friday, Vinfast announced that the SEC has approved their plan to go public next month with a proposed Spac deal.
So remember that there are two ways to go public. One is a more traditional IPO, where investment banks bring the company public. On most exchanges, those are generally reserved for companies that are generating revenue and are profitable.
But of course, if you want to go public before you're profitable, there's the good old special purpose acquisition company method. In this case, Black Spade Acquisition Company was already publicly listed on the New York Stock Exchange under the ticker symbol BSA.
So SPACs hunt around for a company to bring public.
So here are the number of companies that went public using SPACs in the last 5 years.
So 2018, there was 10. And then in 2021, there was 613. So, I mean, as you can see, SPACs peaked in popularity in 2021. And with the markets getting tighter, we've seen fewer lately. As of July 30th, 2023, there have been 82 SPACs that have gone public so far in 2023.
So Black Spade Acquisition Company raised $250 million in its IPO in 2021. It was founded by Lawrence Ho. He's a businessman and the chairman of the Hong Kong-based Melco International Development Limited, which is actually used to be a power company. And it's actually one of the oldest companies on the Hong Kong Stock Exchange. But that was his dad's company. He's kind of, a rich kid. So they primarily invest now in casinos and hospitality businesses in Asia. That's why the story's going to get weird. So Vinfast CEO, Madam Thoy Lei, issued a statement saying, "Today represents a remarkable milestone in advancing Vinfast's presence in the U.S. as we move towards our proposed U.S. listing. Along with this exciting step, today we also celebrate the start of construction of our electric vehicle factory in North Carolina."
But didn't I hear that shareholders of Black Spade have been selling?
Yeah, according to Reuters a couple weeks ago, 80% of Black Spade shareholders have redeemed their shares. Sold them. These redemptions amounted to approximately $147 million. And according to a statement from Black Spade, quote, "Following the redemption, the amount of funds remaining in the trust account is approximately $28.5 million.
Wait a minute. This is making less and less sense. I mean, I thought that this SPAC was valued at $23 billion.
Yeah, this is a bit weird. So Vinfast was going to do an IPO on the NASDAQ under the ticker symbol VFS last December.
Okay.
They were aiming for an evaluation of about $60 billion, but that never happened. BSA had been listed on the New York Stock Exchange, but as it reached the end of its time frame for striking a deal, and so keep in mind, most SPACs have a 2-year charter. They're supposed to find a company to invest in 2 years. They announced last May the surprise merger with Vinfast.
I think this was kind of a surprise to many of the shareholders since they had been looking for casinos or hotels to invest in. And my guess is that Black Spade investors weren't interested in a Vietnamese electric car company.
Right. Then, weirdly enough, Black Spade delisted from the New York Stock Exchange and joined the secondary New York Stock Exchange American Exchange. That's a market for smaller cap companies that has tended to have lower liquidity. It's basically kind of like the New York Stock Exchange's, cousin that nobody visits out in New Jersey.
So earlier this month, Black Spade shareholders voted to extend the lifespan of the SPAC by 1 year, just about a week before the end of its original 2-year term.
Now, I have no idea how Vinfast thought it could justify valuing itself at $60 billion last December, and I still have no idea how they claim to value themselves at $23 billion now.
You may remember that Vinfast shipped its first batch of Vietnamese-made EVs to California last December. It took them a few months before they could actually start selling them due to software issues, so those sales didn't even start until this March.
Yeah, and that was only about 1,000 VF8s. North Carolina offered a big incentive package to Vinfast to build their factory in the state because Vinfast said they would invest up to $2 billion for the first phase of the site. So North Carolina offered them like $1 billion in incentives.
Vinfast says that the plant will have an annual vehicle capacity of 150,000 units.
This construction project was supposed to begin last year, but then Vinfast claimed it was still waiting for the permit, and so they pushed back production of the plant until 2025.
So I don't think that the market is going to be that excited about this IPO or SPAC, I should say.
Yeah, SPACs have been performing really poorly, and I just feel like the market does not have a lot of exuberance for new startups right now. VinFast has a lot of headwinds, as we've talked about before. To take advantage of this IRA tax incentive, they have to make their cars here in North America, and it looks like it'll be years before that happens.
Secondly, they have a brand recognition problem.
Thirdly, the first batch of cars had a bunch of software issues.
And fourthly, I think the customers are going to be hesitant to buy from a new brand, especially if there aren't service centers nearby.
Fifthly, the VF8 and the VF9 models aren't really priced to compete with existing EVs. I mean, they're not even, like, why would you buy one over a Model 3 or Y?
So if VinFast is counting on new investors to keep them afloat, I think they might be in for a sad awakening.
And disclaimer, Jesse and I are not financial advisors. Don't buy or not buy this IPO, because of what we say. Do your own research. But this is where I wanted to tie in disruption and timing. So if we could go back in time and VinFast had made this announcement in, let's say, 2008 or 2010 or even 2012, I think we could be looking at a completely different story. I mean, think about it for a second. By now, VinFast, if they had made a quality car, would be a known brand here in North America, potentially in Europe as well. They would have factories up and running here, so their cars would be eligible for the IRA tax credits. And so most of the problems we just pointed out wouldn't be problems. And because they make EVs and not ICE cars, they wouldn't have had to pivot or change from making gas engines to making motors and batteries. But they started too late. And that's kind of the tale with a lot of these companies. To disrupt, you have to see something before anyone else does. You can't wait so long to jump in. And then, unfortunately, that's what I think a lot of these EV companies have done wrong. They just waited too long. It's not that what they're doing now isn't right. I mean, it's great. They're building a factory and they want to have 90% robots. Awesome. But by the time you actually pull that off and the amount of capital you're going to need to do that, VinFast, like, the market's already moving on to companies that are doing it, like Tesla.
And I mean, right now, you're competing with Tesla. In the future, you're going to be competing with Tesla and whatever beleaguered, glommed together group of traditional automakers are left.
Right. And those automakers have name recognition. I mean, a lot of people stick with brands.
That's
so it's
kind of, I would even argue, all they have left.
Right. And here's the last point. EVs was disruptive when Tesla came out with them in, say, 2008. No one was thinking about full self-driving cars then. Now we are thinking about it, at least the smart people among us, right? And if you watch till the end, good for you, because this is the point. Even if VinFast can pull this off, even if they have a great marketing campaign and everyone in the country loves the brand and wants their cars, pretty soon there's going to be full self-driving cars. And I have not heard a word from VinFast about that aspect. And so even if you make a great EV, if it doesn't have the latest, greatest thing, that would be like me saying, I've got a great phone. Oh, is it a smartphone, Zach? Well, no, it's just a phone. And you're like, well, but the whole world's gone on to smartphones. And it's like, yeah, they don't really care about the fact that you made a phone anymore. It's got to be a smartphone. That's the new thing. No one knows that yet, though. That's why you're watching Disruptive Investing. You know that full self-driving, autonomous cars, robo-taxis, that is the future. If a company you're thinking of investing in isn't doing that well, don't invest in them.
Well, and this gets back to disruption. Right now, the auto industry is going through a disruption, right? We're switching towards EVs. And so we're in the middle of this disruption. And when you're in the middle of this disruption, investing becomes actually a little bit harder because you're like, who do I pick? Now, it was hard to pick before, like back in 2008, back in 2010, it was still like, well, I don't know about this Tesla company. Right. Now, I mean, it's easy because I think you can see that Tesla's the way to go in terms of the way the disruption is happening. But you have a lot of other people just kind of being like, we'll glom on to this disruption. We won't follow any of the same disruptive things that Tesla does, like vertical integration or anything that Tesla's doing. But it sounds a heck of a lot the same. It rhymes. So why don't you invest in us?
You have a huge advantage right now, actually. Mm-hmm. If I'd been talking to you about Amazon back in the late 90s, you would have said, maybe, I guess, I don't know, this guy, Jeff Bezos, he just made an online book company. I mean, sure, I'll put a few bucks in it, Zach. But if I told you about Amazon in 2006, you'd be like, yeah, no, they do a lot more now. And I can see how maybe, I kind of get it. Maybe people will start buying stuff online more. This is 2006 for Amazon. You got through over 10 years of, where people didn't get it at all. Now we're at the point where it's got a lot more value. It's not going anywhere. And I'm talking about Tesla. You didn't get in early, so you missed out on that, right? If you're one of those people who didn't get in early. But you get a chance to get into Amazon at 2006. Would you like to do that? Would you like to go back in time and invest in Amazon in 2006? Yes, you would, right? Same thing here. You didn't get Tesla from IPO days, but you're going to get Tesla from now going forward. And you might be like, well, there's not much left growth. I mean, what are they going to do next? There's a lot more coming. It's like when Amazon was just at the early days of selling online, before Prime, before AWS, before any of that. That's what you're getting now.
Before Alexa, before, there's devices in all of your houses that have stuff that is connected directly with Amazon.
Right. And you see other players like Walmart who are now still just trying to break into the market. They could have beat them. I mean, Walmart was huge. If Walmart saw this coming, they would have easily beaten Amazon. But they're like, no, it's all about having physical stores. That's what they were focused on. It seems so easy in hindsight to say that they could have done it, just like it's going to seem easy in hindsight to say, why didn't VW, Ford, GM, Toyota, Honda do it? They had all it took. They had the money. They had the brand.
And they could have done it.
They could have.
This is something that we talked about way back in 2016 and 17.
Let me ask you this. If you're a young engineer with lots of brights and smarts and you were said, I'll go work for this startup company, Tesla, that might not be around in a year, or I'll go work for Honda, you would choose Honda. But they weren't hiring. And that's the difference. They were still making engines. So I hope this was helpful for you. And let's move on to the next story. So I thought we'd check back in on QuantumScape, the solid state battery developer. They're listed on NASDAQ under the ticker symbol QS. As you may know, especially if you're a member of our Now You Know Investor Club, which you can join, by the way, by going to Patreon. The link is down below. I love stock charts. I'm not a big fan of just saying QuantumScape is up 22% this year, which it is. I like to see a certain time frame and follow how the stock has moved over time. So here's a 1-year chart. And yes, we have seen a recent pop with the Q2 report, which we'll be talking about in a second. But if we look at this 3-year chart, we get a different perspective.
Wait, is this the same company? The 1-year chart looks so exciting, and this 3-year chart looks so flat.
Yeah, well, you remember soon after QuantumScape went public, we had that EV frenzy, and anything to do with EVs had this FOMO. Now, the more rational aspects of the market have taken hold, and we get a more reasonable valuation, in my opinion, currently at $5.9 billion, which I think is still kind of high, but let's get into it.
So remember, one of the reasons we invested in QuantumScape was because we wanted to follow it more closely for you and our investor club.
But also, JB Straubel is on the board of directors of QuantumScape. He joined in November of 2020. As a co-founder of Tesla and now back with Tesla as a board member there as well, it was intriguing to have a guy who knows so much about batteries being on the board of a battery company.
It feels like JB helps us investors to weed out which battery companies are legit.
Exactly. You kind of figure he wouldn't be on the board of a battery company unless he felt it had some serious potential.
In 2020, QuantumScape announced that they had reached a major breakthrough by utilizing a proprietary ceramic separator.
Then they tested a single-layer prototype cell, followed by a 10-layer cell, then a 16-layer cell, and by Q2 of 2022, they had a 24-layer cell that was pretty energy dense. In December of 2022, QuantumScape began delivering the first of these 24-layer prototype cells to automotive partners so they could then test them themselves. And by Q1 of this year, testing has been completed by at least one of these unnamed EV OEMs.
QuantumScape's first commercial solid-state product will be a 5 amp-hour cell called the QS-E5. And according to their Q2 report, QuantumScape is now shipping these cells to partners as well. So
let's take a look at this chart that was in their Q2 report. Okay, are you looking at it? Those 6 dots are the current technology, 18650 and 2170 cells from Porsche, Tesla, and Rivian.
Okay, so the higher we go up on the left, the less charging time it takes to fill the battery. And the further we go on the right, the more energy density we get in the cell.
Correct. So you can see that Rivian has a 2170 cell that's energy dense but takes longer to charge. Porsche has a less energy dense cell that is quicker to charge. And Tesla is currently kind of like in the sweet spot of pretty energy dense and pretty fast charging.
But wait, what are these 2 green swaths up here on the right?
So the smaller, darker green swath is the QS5 amp-hour battery that QuantumScape is coming out with. So you can see it'll be more energy dense and have faster charging speeds, if we believe them. And then there's going to be a larger format QS battery, which would have even higher energy density and even lower charging times. The next chart here shows the time it takes to get to different states of charge.
So the gray line is the, quote, top-selling long-range EV pack currently available, and the green line is QuantumScape's new cell.
So QuantumScape is hoping to hit an 80% state of charge in 15 minutes, which would take the current top-selling cell about 27 minutes. That's quite a difference if they are to be believed.
QuantumScape claims that these new cells passed all of the EU car and SAE safety tests, including nail penetration, overcharge, external short circuit, and thermal stability testing up to 300 degrees Celsius.
QuantumScape ended Q2 of this year with over $900 million left in liquidity and believes it has enough runway to keep going into the second half of 2025.
Sounds like they're already working with an EV partner.
My guess would be VW, but I think the big question is the cost to make these cells at scale.
Yeah, this has kind of been the issue for the past many, many years. On this show, we are constantly being bombarded by press releases saying that some new battery chemistry is going to be better than old battery chemistry.
And while I believe that's true, it's just not about making a better battery. It's about making a better battery that is cheap enough to make it at scale. Because if I can make a battery that is twice the energy density that Tesla's is, but it costs more than 4 times to make it, it may not be economically viable.
Exactly. There's a lot of potential here, but I'll get excited when I see an EV company actually putting these into their cars and being able to reduce costs.
And that's kind of the big question mark. And I think why there's such a big valuation on the company. If they can pull this off, if the cost of this battery is low enough at scale, then they're onto something pretty big here. But if they can't do that, then no one's going to care about this battery.
Well, and this is a really tough place to be in as an investor because you have to kind of be a battery expert now.
Right.
And because you can't just kind of take them at their word and you can't just take us at our word. What the hell do we know?
Right.
Now you have to start getting into like, oh, what's a separator and how does a cathode be affected by it? And it's like, this is kind of stuff where it's really hard. You now have to turn into some kind of battery scientist. And what I think is maybe more important, or another tack that you can take, is to take this information as, okay, maybe it's this company, maybe it's a different company. Here's what I think could be possible. I know that right now these battery cells are not at cost parity with traditional battery cells that we have in our Teslas, right? You know that because otherwise they would be producing them. Or maybe they are cheaper, but it's impossible to produce enough of them or something like it. The processing is really difficult or expensive or time consuming. So we know that this stuff is coming, right? We know that.
Right.
Because it must come down with scale and with people working on it. It's going to get better and cheaper and faster. And maybe it won't be QuantumScape, maybe it'll be some other company. What can we do with that information? Because I think that most people don't even read this kind of stuff from QuantumScape, right? They don't even get this information. As investors, you need to have the best intelligence and, like information, and you then need to apply it. So one of the ways that we can use this is to think about what is going to happen in the future if a battery like this were to, say, go into a Tesla car or into a different, one of Tesla's competitors.
Well, and that's what's so interesting about ICE engines. Over the years, obviously, ICE engines have gotten more efficient. Mm-hmm. They've gotten less noisy, less polluting. But to do that, they haven't been able to. The curve gets really kind of flat there at the top. There, you have to put more and more money and research into getting very little left out of that engine, that technology. Batteries, I feel like, are in their infancy. I feel like the more that we're throwing at this, we're getting amazing breakthroughs. And it's, like you said, only a matter of time before the batteries become better and better and better. And if the car is this good now, if your Model 3, for instance, I think is just great, it's only going to get better and cheaper. And that's what's so amazing here. We've been telling you that there's going to be this amazing EV adoption. This is one of the ways you're going to get there. Mm-hmm. The last point I want to ask you about is, it was pretty cool to see that JB joined the company. And when he did, he was not on the board of directors at Tesla. In fact, he had really no ties left with Tesla. He was a co-founder, but he had left and he had started Redwood Materials. Now, he was just elected to the board of directors on Tesla. Kind of weird to wear these two hats, right? Because he's getting inside information about both companies. I don't know exactly how that works because he does know what QuantumScape's working on. He does know what Tesla's working on. I don't know what his NDA looks like. And so a lot of people have conjectured, oh, well, it's Tesla that's going to be using this next battery. That's why he did this. It's possible. Tesla's done this before, right? They bought Highbar. They bought Maxwell Technologies.
And that's what they used to make the 4680 cell.
Right. And a $5.9 billion company could be bought by Tesla. Right. It's not inconceivable since Tesla's worth $900 billion. So that's another play. And I'd love to hear your thoughts on this. And I'd love to talk about this on our Patreon Investor Club Slack. So if you head on over to Patreon and join our Now You Know Investor Club, this is the kind of thing we talk about. Because if this is true. If maybe the reason JB joined this company is because he's like, oh, this is the battery tech. Don't forget, JB has seen batteries since the 80s. He's been going and visiting battery companies. He knows all these techs. If like for you and I, the investor, we're not up on all this probably. He's like the guy when it comes to batteries. So he might have gotten super excited about this company and decided to join them because he thought they were heading in the right direction.
Or maybe he just wanted to find out more.
Maybe.
And that was one way that he could do it.
It's possible.
Because you probably can't know everything until you are the board member.
True.
I don't know. That's another way to look at it.
Yeah. So what do you guys think? Let us know down below, because I mean, this could be coming Tesla's way or coming to some other car company's way.
Thank you so much for joining us on Disruptive Investing here. We do this weekly show because, there's a lot of stuff that we want to talk about in terms of investing and stock stuff, and it's very fun. I also want to encourage you to subscribe if you haven't already, because we also do lots of interviews with CEOs of companies that we think are kind of disruptive, or maybe we think they aren't disruptive and we want to talk about it.
And that's one of the fun parts about doing our investor club. There you get to actually talk to these CEOs and founders on our live stream. So I urge you to join that. It's really, you're going to get your money's worth, believe me.
Thank you so much for joining us. We'll see you next time on Disruptive Investing.